Let's move on here. A name that I know you are very bullish on, one that you've had for some time, Aritzia. Pretty impressive quarter, I'll be honest. I was doubtful about Aritzia in the last couple of years, but they're definitely proving me wrong. I was more bullish with Lululemon, and haven't checked the price of Lululemon recently, but I'll just assume it hasn't done all that well. But Aritzia is delivering, and I think it's reminding me why I should not be investing in the world of fashion. I think it's just
a lot of people, I guess it's kind of a harsh term, but a lot of people were dumpster diving in terms of companies like Lululemon and Nike, which they're not necessarily bad companies, but they're just companies that are going through a bit of headwinds right now in terms of resonating with the consumer, assortment issues like inventory buildup, things like that. Whereas, I mean, Aritzia just doesn't seem to be going through any of those issues whatsoever. They topped expectations on both the top and bottom line, but the big thing is they beat earnings expectations by over 50%. I think the markets, it was a pretty rough day for the markets when Aritzia ended up filing. I think they opened up at like $90 a share, but ended up selling off. I think if we were on a green day, I think you would have seen Aritzia probably close over 90. And I think pre-earnings, they were 78, $79 a share. Revenue grew 32% year over year, which is well above internal targets, and U.S. revenue came in just shy of 60% of total revenue. When I first started covering Aritzia over at Stock Trades, I think this was back in 2018, I believe the U.S. revenue base was under 40%. I'll show the chart of just how fast the U.S. segment for Aritzia has grown. If we look to United States revenue and Canadian revenue, we can see since 2014, we're looking at a 33% compound annual growth rate on U.S. revenue, whereas the Canadian end is only around 12.91. 13% is not a bad growth rate, but you can just see how dependent this company is on the U.S. Back in 2023, it actually overtook Canadian revenue. So you have a pretty large untapped market for this company, and they're just taking advantage of it right now. Same-store sales were up 22%. So that actually goes back to pandemic level growth, and I'll go here to comparable sales. So the company was growing. There was a few quarters back in the pandemic where it was growing same-store sales at a 30-some% pace. And then we get into 2023, they ran into a bunch of inventory issues, and it ended up flatlining. And now we're returning back to that pandemic level growth. And this is a prime case where in fashion, you don't fight the trend. I mean, it's just crazy the level they're growing at. U.S. revenue, 41% growth. Canadian revenue was 21% growth. The company's gross margins increased by 360 basis points. And this is actually pretty crazy because tariffs had 220 basis point impact to margins. So we're looking at a near 6% increase in gross margins if we actually didn't have those tariffs. Adjusted EBITDA more than doubled year over year, and EBITDA margins increased by more than 6%. The company is guiding to 22% revenue growth this year and EBITDA margins to come in around 15.5 to 16%. And they had mentioned that if tariff impacts didn't exist, EBITDA margins would be closer to the 19% range. And this was actually a target that they set to hit at the end of next year. So if you isolate out tariff impacts, they would have hit this target a year early. Obviously, you can't completely isolate them out. Tariffs are an issue, but it just goes to show how well the business is doing without things that it really can't do anything about. And they do have a lot of flexibility in terms of forward growth because they have around $350 million in cash on the balance sheet and they don't carry any debt. And as you had mentioned, fashion is very tricky, zero doubt. Who would have thought Aritzia, which is kind of like a mid-tier fashion company, it's a very niche fashion company, would be growing same-store sales at a 22% pace, while companies like Nike and Lululemon can't even post positive comparables. The macro environment is terrible for a lot of these companies, but it just isn't really showing up in the numbers for a company like Aritzia right now. And it brings a question like, what happens to this company when the macro environment improves? We had strong GDP growth in the US, but I'm pretty sure I read some studies. If you take out data centers, it was effectively flat on a year over year basis. I think the consumer there is really struggling still, but it's just not showing up in a company's results that they sell expensive clothing.
It's a classic K-shaped recovery, right? Like you're seeing people either doing well because they own assets. So you're seeing a part of the economy doing well and still spending. And then you're seeing those who are just struggling to make ends meet and don't have any assets, I can guarantee you they're not buying Aritzia
No.
clothes. It's probably that upper part of the K. And as long as that one stays strong, it should do pretty well. Again, with the caveat that with the fashion play, you never know which way it's going to go. If you'd like to listen to the full episode, head to your favorite podcast player and type in the Canadian Investor Podcast. If you'd like to watch the full video, go to jointci.com and you'll be able to subscribe to our Patreon page. On top of that, you will get the podcast feed ad-free. You'll also get our monthly portfolio update and my parents' retirement portfolio update, which I manage myself.